All right, so let's talk about this. Last week, I said mortgage rates finally got some good news. We had weaker employment, some friendly inflation data, and bonds finally had something to work with. And then the bond market basically said, not so fast. Rates moved back towards the upper end of their recent range. 10 years back around 4.7. And why? Because there's a much bigger battle happening with long-term bonds. And this is why I don't tell people one good economic report means mortgage rates are headed straight down. So let's look at this. The 30-year Treasury is flashing an warning. This is really a new story. Reuters reports that long-term global bond yields have surged with the 30-year US Treasury reaching its highest yields through 2027. So, or 2007, pardon. Now, inflation is still an issue. Massive government borrowing matters. Treasury supply matters. Investors demand more yield to hold on to long-term debt, and that pressure can bleed into mortgage-backed securities. So mortgage rates don't live in a vacuum. Remember that. It's not a vacuum. If investors demand more money to own long-term government debt, mortgages have to compete for those same dollars. Mortgage-backed securities, right? This is something that we've talked about. Mortgage bonds, what are they? They're backed by mortgage-backed securities. It is a bond. It's a long-term play, right? Like a treasury. So the treasury buyback story. Let's talk about this. We talked about this a little bit last week. We're going to talk on it more. The treasury announced that it would double certain long duration buybacks from 2 billion to 4 billion. And MNB specifically cautions mortgage news daily, specifically contests that this isn't QE. It's not quantitative easing. If you want quantitative easing is, great book on it. It's called Fed Made Simple. I wrote it. It's on Amazon. Check it out. And it wasn't the primary driver, though, of the subsequent bond volatility. So remember, Treasury is basically offering buyback with some older, less liquid bonds. This is not QE, quantitative easing, where you're buying bonds, or the government's buying bonds to artificially help stimulate something with lower bond yields and, of course, improving pricing. So the government's printing money to lower mortgage rates. And that's not what's happening. It's a liquidity tool. It can help how a treasury market functions, but doesn't magically create 5% mortgages. It's a myth to think so. This is myth breakdown. You can't just buy something and expect it to happen. It's not just a cause and reaction. It needs to be other places to do that. So now this is what we look at every year. Jackson Hole Summit, right? This is probably the biggest forward-looking story of this week. So watch out for this. And to get my weekend write-up, shoot me a message. I send this out every Friday. Love to have you on these emails if you're not getting them. I have 3 versions available and I do a blog post. But this is a summit that happens every year in Jackson Hole, Wyoming. The Fed chair, Kevin Warsh, is preparing for his first Jackson Hole address as chair. And Reuters says bond investors are intensely focused on what he's going to say about inflation, future monetary policy, and the Fed's independence. This time there's an interesting twist, though, unlike last year. Very interesting. Markets are worried about hikes, not cuts. Again, worried about hikes, not cuts. Reuters reports markets are pricing roughly a 35% probability of a September rate hike and 66% by December. So remember, when everybody spent 2 years asking when the Fed would cut, now Wall Street's debating whether or not they may have to hike again. Huge thing to think about. So housing isn't crashing, it's grinding. The one market in this country that does not make sense, my hometown, San Francisco. What's going on up there? Crazy stuff. Why AI? Why cash? Why cash is king? Why people are buying houses crazy at crazy exponential offers. You're going to see something go 20, 30% over ask, over list price. Why? Because they can. It's happening right now. Nationwide, though, it's a little bit different. We're seeing days on market increase in some markets. But watch out for, again, San Francisco, San Mateo, Oakland, so Alameda, and Contra Costa counties, certain parts of Contra Costa counties to be exact. Those markets, still multiple offers, especially the larger metro areas, Oakland, San Francisco. 40 offers on the property. It's the hottest market we've seen. I talked to an agent on Friday. He's a top performer, has a team of 50 agents. He's like, it's crazier than what you and I saw in 2020 and 21, the COVID era. This is insane. Why? Well, cash is king. They don't need loan guys. We're still here. If you need a loan, call us. But a lot of them are buying cash, and they're buying if something's listed for a mil, they're going to offer two. I'm not kidding. It's happening right now. So let's look at nationwide though. Mortgage News Daily's latest data Pending home sales fell 2.3% in July. It was a little slow in most markets in July. Existing home sales dipped slightly, but remained above last year's level. Mortgage applications were basically flat. Builder confidence ticked higher, but remained subdued. And affordability continues to be the problem, especially here in California. Housing isn't collapsing, it's grinding. That's actually a fantastic description, I think, for 2026. The buyers aren't rushing, sellers aren't capitulating. Transactions are still happening, but affordability is limiting volume. So here's the buyer opportunity no one's talking about. This connects beautifully to the stuff we talked about previously. Everybody wants 5.5% rates in today's negotiating environment. They may not get both depending on where you are, but we are seeing seller credits, price reduction, inspection leverage. We're seeing fewer competing offers in some markets, temporary buy downs, financing contingencies, creative loan structures. So if rates meaningfully fall, if rates come down, we've talked about this before. It's like red light, green light. Play this with my kids. Red light, stop. Green light, go. Red light, 6.5%, 7%. Green light, once you break that 6% range, you're dealing with 30 offers on the property. Don't believe me? When it happens, give me a call. We could discuss what I'm seeing at that time. Everybody wants lower rates. Nobody wants the competition lower rates could bring back. So what we're seeing, VA offers getting accepted in some markets. Down payment assistance, down payment, they're getting accepted. This isn't the guy from CNBC telling you this. This is actual news. This is what I'm seeing on the street. I saw 49 applications come through our office, myself, my assistant, and a junior loan officer. So we are seeing people apply. We are seeing people want to get pre-approved. We are seeing people get into contract. I'm not kidding. VA down payment assistance, they're working in this market. They don't work in other markets. Why? Because if you have is that cash buyer, that's number one for a seller. Second is conventional financing with substantial down. Third is conventional financing with less than substantial down. Let's say 10%. Then FHA, then VA, then Lord forbid, Cal HFA. We're seeing them get accepted. In fact, I'm closing 2 Cal HFA transactions tomorrow. It's happening, guys. We're seeing TIC financing. TIC in LA, multiple offers on most of them. I'm not kidding. Work with a great group out there. We do quite a few of them. We've actually, in the last 12 months, have been able to close 38 TIC transactions. We're seeing bank statement loans, DSCR loans, non-qualified mortgages. We're seeing non-warrantable condos. After the new condo laws that we saw from Fannie Mae, it came out a mortgagee letter that came out earlier this spring. I did a full presentation on it. Check it out on this channel if you haven't seen it. Good to know. We're seeing the need for full underwrite before you make an offer. Why? Because if you're in Oakland and San Francisco and you're competing against cash, you need somebody who could close in 7 days. It's a fact. So it's worth it. If you want to get up with that, we know the market well. Agents know we know it well. It could help. So we don't need to predict the bottom. We know your number. We also have something called a strike rate. When rates drop, we're going to call our clients. In fact, we are preparing some because we do think eventually things are going to drop again. We've gotten out of one message I sent, an email, the 50 plus clients, we got 38 people responding. We know people bought, they took advantage of the market. Those markets appreciate. Now they're sitting on equity. Now they could refinance when rates drop. And yes, I just held a whole spiel, law of energy. I get it. You just watch that part. Interest rates, they may go up in the fall. They may also come down. They may come down at the end of fourth quarter. They did last year, right? And it comes down for about a week and it goes back up. You want to be ready for it. So the Fed isn't our biggest problem. The long end of the bond market is. And that's the thread connecting really everything that we talked about this month. Remember, Fed funds rate does not mortgage interest rates. We have to watch the treasuries, 10-year treasury, long bonds, mortgage-backed securities, which is a bond, inflation expectations, government borrowing. So 3 weeks ago, we talked about the market moving on the Fed, then jobs weekend, then inflation gave us some good news. And now long-term bonds are reminding everybody that this isn't going to be a straight line. But remember, nothing in the markets move in a straight line. So don't predict rates. Don't predict them. Don't predict them. Don't predict them. Prepare for rates. Know the payment that works. Know the refinance number that works. And when the market gives you the opportunity, that's when you get a move on it.